I'll just do the third one. Get out of that. Go back to screen share. Or, go to screen share. And then change it from, yeah, hit that again now. And then just do this. Yeah, exactly, that one. And then start screen share at the bottom. Okay. And now hit your full screen. There you go. There you go. Before it was doing your desktop, so that one that would actually work.
Oh, we're not muted. I muted myself.
No. You're fine. You're fine. Let's see if someone can hear you. Just click the link. Because it's delay, right? So that's fine. I'm not doing it.
That's why I think.
So actually, go ahead and go back out and we can mute the. This part is, it still looks fine. It doesn't really matter. Just mute the mic.
This one.
Did you mute it? Someone has to mute it. We're just still like going back and forth between that.
Why is it doing that? What should I do? Should I tell everyone to?
Make sure everyone's muted. At this point, it's like 5 to 10 minutes anyways. You can, I mean, it honestly doesn't matter. It doesn't mean it need that take forever. You can just be like 10 minutes. Get started. Like, there's no one there anyways. We have no idea yet. You know what I'm saying?
I understand.
It's obviously just delayed. So we move it back and forth and picking it up both ways. It's picking this up and then about 10. So like you can't be in here listening. Or you have the answer. Right. Can you hear you? Okay. Just kind of wait. We're just waiting.
guess there's no hashtag for this.
So, I figured out why you're getting all this stuff. You had like 4 of these actual pages open. So it was like playing different versions of our exact segments. So it was like our voices too. It's like, why we're not talking. But now it's live. There's sound going. There's no sound going. Okay. So in about 5 minutes, you want to queue up and let everyone know you're ready to go. Starting at 4. Right. Starting at 4.
Yeah.
And this is good because once this is done, we can take the video and chop it up and get it with all that stuff. So it's really easy. Yeah, we're live. But we're on mute, so you're fine. Yeah, you can sit down. That's fine. Hi, Lisa. Like, let everyone know, hey, undo your mics and we'll get prep for showtime because you want to be able to have a top 4 o'clock. About to be on the air. Skate time. Do you like anything to drink? Okay. Because talking, it does sometimes. Like,
If there's a water around, maybe.
Sparkling water good?
Yeah.
I'll come back with it.
Perfect, thank you. Hi everyone, I'm Linda Sherry from Consumer Action. Welcome to our Hangout on Air today, and we're putting it on in conjunction with Chase Blueprint. And we're going to discuss how to better handle one's finances in the wake of the recession. And we have tips for personal financial recovery, and we're going to hear from Aite Group about a great survey they did. So just wanted to welcome our participants. We have Jerry Detweiler, who will be our moderator. We have Tom O'Donnell from Chase. And we have Rick Harper from the Credit Counseling Agency in San Francisco, and Ron Shevlin from Aite Group. And they will explain who they are a little bit to you. So take it away, Jerry.
Hi there, I'm Jerry Detweiler. I'm Director of Consumer Education for Credit.com. I've been involved in consumer credit education for more than a couple of decades now, and now with Credit.com our goal is to really make credit very simple for consumers. We give them a free credit report, we answer a free credit score, we answer questions about their credit on our blog, and we publish lots of material. But financial literacy and financial health are near and dear to my heart, so I'm really excited to talk about the research today.
All right, next we'll hear from Tom at Chase, Tom O'Donnell.
Yeah, hi Linda, thank you. It's Tom O'Donnell from Chase, and at Chase we're really glad that we have the opportunity to participate in this hangout today. The things that we'll be speaking about, particularly as we look at what we consider mindful spending, which is how consumers spend and borrow, we believe any dialogue around that and elevating the conversation around that is a good thing. We're proud to have sponsored the research that we'll talk about today because we think it fully supports how we're trying to communicate to consumers and customers around their spending and borrowing.
Thanks, Tom. Rick, I seem to have mangled the name of your agency, so why don't you take it away?
It's not an easy name. This is Rick Harper with Consumer Credit Counseling Service of San Francisco, and I'm responsible for the consumer education and outreach in housing and credit, and very happy to be here today to give you some observations of what we've learned from dealing with hundreds of thousands of consumers in the past 5 or 6 years dealing with the effects of the recession. So thank you for asking me to participate.
It's our pleasure. Now we're going to hand it over to Ron Shevlin from Aite Group, and he's going to tell us about this research, and it's very, very interesting. Ron, take it away.
Thank you, Linda. I'm Ron Shevlin, Senior Analyst with Aite Group in Boston. We are a research and advisory firm serving the financial services industry. My own research typically focuses on consumer behavior and financial services, and I look very closely at how consumers manage their financial lives and interact with their financial providers. And had the opportunity a few months ago to work with Chase Blueprint to survey a little over 1,200 U.S. consumers, a representative sample of the overall population, to understand not just how they manage their financial lives, but more specifically how the recession has impacted them, how it has changed how they manage their financial lives, and how it's impacted them from a financial perspective. And there are a couple takeaways that I'd like to leave you with to kind of kick off the discussion here, some of the key points that I think are most important. First and foremost, although there are many signs that the economy is improving in 2013 from the sort of the depths of the recession in the 2010-2011 timeframe, the improved economy has not lifted all boats across the board here. Many consumers still say that their financial health is not in very good shape, though many consumers did have improved. Overall, the percentage of consumers who say that their financial health is very good or excellent increased a few percentage points, but on the downside, the percentage of consumers who say that their financial health is very poor also increased between 2010 and 2013. And there are a couple of factors and drivers that I think we uncovered in the research to help explain some of this. The first is clearly unemployment, and clearly if they're employed, but that number is still not very high. That doesn't even account for why so many people's financial health would have declined from 2010 to 2013 from even the depths of the recession, even as the economy improved. Instead, there are a couple other factors I think that are really impacting consumers' financial lives, and the first is the extent to which they consider themselves to be financially literate. That's kind of a loaded term because there really isn't a clear definition for what financial literacy means. There is no score, nor something that we can actually grade people on. We ask them, consumers, about their perceptions of how literate do they consider themselves to be in terms of their perceived knowledge to help them make financial decisions about what products they need, what providers they should choose, and how to save and how to invest. And the good news is that the Americans believe that their financial literacy rates have increased from 2010 to 2013. Among the people we surveyed, about 40% of them considered themselves to be financially literate in 2010, and 55% of them consider themselves to be financially literate today. So that's good news that the literacy is rising. The bad news is that 55% is still a very low number. The thing that I would also add to this, and I think it's probably something that many people probably would not guess, is that the differences in the perceptions of their financial literacy across different income ranges is not very significant. It's not very big at all. About half of consumers who make less than $30,000 a year consider themselves to be financially literate. Among consumers who make more than $70,000 a year, that perception, that number only goes up to about 60%. So in other words, looking at it from the other perspective, among consumers who make more than $70,000 a year, 4 out of 10 consider themselves to be not financially literate, and that's clearly a problem in terms of managing their financial lives. The last dimension that I want to bring up here, we'll discuss this in a bit more detail as we go forward, is the notion of financial complexity. That is, how complex does somebody perceive their financial life to be? And what we found is that while many people consider their financial lives to be complex, that's not driven necessarily by how many financial products they own. We all own a wide range of financial products, and we get them from a wide range of financial providers. Instead, what really seems to be driving people's perceptions of complexity is how many different sources do they borrow from? Are they borrowing from the bank, from their credit card provider, from payday lenders, from their friends? And when people are in that situation, when they're borrowing from many sources, they tend to believe that their financial life is more complex. And coupled with a perception that they are not financially literate leads to a perception that their financial health is not in very good shape. So when we think about this in terms of how do we help consumers, a couple of key points. One is that while income is important, even consumers who are at the upper ranges of income do not necessarily consider themselves to be financially literate or that they have an easy time making decisions. And number two is that this is very important from a financial institution perspective, because consumers who perceive themselves to be financially literate, not have a financial life that's very complex, and who believe that their financial health has improved over the past couple years, are the consumers who are most likely to not just stay with their existing financial providers, but those that are actually growing their relationship. So this is very important from a financial institution's perspective to help consumers become more financially literate, get a grip on the complexity, and improve their financial health.
Ron, you touched upon the idea of financial health. How does it relate to financial literacy? Did your research look into that at all?
Yes, Sherry. The health is a perception that's being impacted by the extent to which people believe that they are financially literate. The higher their level of perceived literacy, coupled with a perception that their financial life is not overly complex, leads to a perception that their financial health is okay, even if they're not making a lot of money, even if they don't save a lot of money at the end of the month. They still believe that their financial health is at acceptable levels because they feel like they have control over it. They have the confidence to manage their financial life. I think that's the important thing, is that the literacy levels helps drive confidence even if they're not necessarily at high levels of income.
I thought it was very interesting in the research where you talk about financial complexity and what an impact it has on financial literacy and financial health, because I think a lot of us feel that our lives are pretty complex today. So I'd love to get some viewpoints from some of our panelists about ways to reduce financial complexity for consumers, for our audiences, for those we try to help and work with. Tom, let's start with you.
Sure, thanks, Jerry. When we think about complexity, really complexity is in the eye of the consumer. And consumers, when you really ask them to define complexity, it comes down to whether or not they can comfortably and confidently make financial decisions. If they don't feel that they can, they view that as a complex situation. If they feel that they're comfortable and confident, they don't view that as being complex. So it really is based on that individual's perception of their own ability to be comfortable and confident, and that's their judgment of complexity. In our research, what we've learned is that that comfort and that confidence really comes from three things. One is that a consumer feels like he or she's in control. The second is that they feel that things are simple, that there's a level of simplicity. And the third is that they have a predictable financial situation. So if they feel that things are under control, they're simple to understand, and they're predictable, based on their own definition, then that reduces their complexity. So I'll give you an example. Today, consumers might have a $2,000 debt associated with their credit card and a $100,000 debt associated with their mortgage. Most consumers view that $100,000 mortgage as being less complex because it's simple and predictable. I pay a certain amount every month, and I may pay that 12 months a year for 30 years for $100,000, but even though that debt has a bigger influence on their financial situation, they feel confident about it. The credit card debt, which might be a fraction of that at $2,000, if they don't have a clear way to make that into something that's simple and predictable, then they feel less confident about making their decisions around that. We did that research a few years ago. We introduced some features, we call them Blueprint, which allowed customers to take that $2,000 credit card debt and turn it into a monthly payment. Same amount of money that they owed, but now it was simple and predictable. Immediately, their confidence in managing their credit card debt went up. And it was really a matter of them feeling they had control, they had something that was simple and something that was predictable, and that was their way of managing their complexity.
Well, along those lines, Tom, we've seen, I think, vast improvements, for example, in credit card disclosures and other disclosures, and I know the CFPB is working on some guidelines, some issuers have taken initiative. What's been your experience with Chase customers in terms of communicating with them in a more straightforward way? Has that helped?
Absolutely, that always helps. And it really comes back to, can you communicate in terms that the customer or a consumer understands, so that, again, they're more comfortable and confident in what the product that they have and how they're able to utilize it. Because if you start with the products that people already have, whether it's their checking account, their savings account, their credit card, and they really understand it, and they become comfortable with the terms and conditions and how it works and how they can pay and how they can pay down that balance and what fees might be attached to that, it really raises their confidence. And once that's in place, they feel a lot better about the product that they have and how they're able to use it. So whether it comes in the form of disclosures and information, or if it comes in the form of some kind of helpful tools, any of that really raises what really is the operational view of literacy around the product.
Linda, I'd love to get your perspective too. Some of the folks who are joining us for this Google Hangout may not realize that Consumer Action serves consumers all over the country, and you also publish a lot of consumer education material in many languages for consumers who may not be that familiar with the financial services industry and the products they have here in the U.S. So can you talk a little bit about complexity and how that ties into your financial literacy efforts?
Well, I thought it was extremely interesting that the research showed this because as we saw in the research, when you're juggling more financial obligations, it creates more opportunity to miss payments and to basically feel that you're not in control of your finances. So, my advice to people is to really, first of all, face up to what's going on in your financial life. Know what the different, cards, lay them out on the table, and make sure that you understand that you can be in control. You can start maybe with paying the smaller debt off and working on to the larger debts. Obviously, I think everyone knows that if you don't pay your bills on time, especially with loans and borrowing, when you borrow money on credit cards, etc., it can affect your credit history. And when your credit history is no good, then it's going to affect your ability to borrow in the future. And that's going to cause more stress and more complexity in the future. So I really think that people need to sit down and arrive at a plan. And it's really not rocket science. It's just we've got to pay our bills and get a control of the borrowing that we have done in the past. And the other thing is, I think, many people are ashamed of the idea that they have overwhelming debt. We have in this country bankruptcy laws, and while it's an absolute last case scenario, I think there are certain people that do really need to know that those laws are there to let them have a financial fresh start.
Rick, Linda mentioned sitting down and creating a plan, and that's what you do every day with consumers who call or come to see you at your credit counseling offices. Tell us how you see this issue of financial complexity and how it plays into the consumers who reach out to you for help.
I think we might have lost Rick, actually.
Oh, I think we did. All right. Well, we'll grab Rick when he comes back. I see there. Okay. Ron, I'd love to talk a little bit about borrowing and spending post-recession. We hear, consumers have really tightened up, and then we hear they're starting to spend again. What do you see the trends at?
Yeah, it is a bit of a mixed bag there for sure, but I think we've got to look at this in terms of the consumers whose financial health has improved versus those whose financial health has declined. Among those whose financial health has improved, and that represents about a quarter of Americans, what they're saying is that they are actually spending less on a weekly and monthly basis, that they're getting their expenses in order. Many of them just are doing that through tightening their belts. Many of them actually said that they're reducing their level of spending because they're doing a better job managing offers and coupons and things like that, versus consumers whose financial health has declined, who are not as likely to say that. But the other thing that I think is also very important that we heard from the consumers that we surveyed, and this kind of really cuts across the board, across all ages and income levels, is that by and large, many more consumers are paying off their credit card bills in full every month compared to what they were doing not just a few years ago, but even pre-recession. Many consumers, so it really is a good sign in terms of the percentage of consumers that are really kind of getting a handle on their financial lives and instilling more discipline into it from a spending perspective, so that although many consumers are still struggling for sure and borrowing from many places, the trend in the credit card side, and Tom, maybe this isn't great news from a credit card provider perspective, but all in all, it's a good sign from a financial health perspective that many consumers are paying off their credit card bills in full.
So, Ron, can you just recap that for me? Are consumers spending more on their credit cards but paying more off, or are we just seeing the spending still at lower levels than before?
The increase in spending on the credit card side, and Jerry, you probably have a lot of this where you are, I think is a much more recent trend. If we look at the period of time from 2010, at the depths of the recession, to 2013, the run-up in credit spend is much more recent. I think it was still very low in the 2011-2012 timeframe. But I think what consumers are basically saying is that they, even over the past couple of years, more of them are paying off that credit card bill in full. And those that, and I don't know, but I would guess that reading into the research is that the consumers who are spending more on their credit card are probably doing so because they're comfortable that they can pay it off every month.
If you're just joining us, we have a Google Hangout going here. We have Tom O'Donnell from Chase Card Services. We have Linda Sherry from Consumer Action, Rick Harper from Consumer Credit Counseling Services of San Francisco, and Ron Shevlin from Aite Group. And Ron is sharing the results of recent research sponsored by Chase looking at consumers' understanding of their financial situations and financial literacy. Rick, we lost you there for a second, so we're glad you made it back.
Technical glitch.
We want to get your perspective. We were talking about the fact that you talk to consumers all the time. They come into your offices. They call your service for help with their debt. How does financial complexity tie into those consumers' need for help with their credit cards or other types of debt?
Yes, that's a very good question, and I think people or families in crisis, when they come in, they often make the wrong decisions around how they manage their debt. And I think if you had a family that was maybe making it, everything was working fine, but all of a sudden they had a reduction in income, as we've seen many times, then the overuse of the card, the maximizing the fees that might apply to various accounts comes into play. While they were managing it, while they had income, when the income is lost, when there's a crisis, these fees come up, and then when you survey them, they feel like they're out of control. They feel like they don't have any options. And so therefore the complexity, it's not surprising at all that the products that when they surveyed people that had the most fees associated with the products because of the way the client or the customer used the account, that they felt like it was a very complex situation. What we try to do is to break it down again to the very basics of understanding the products used. Many people who don't have access to traditional financial products are in that same boat. That's the unbanked group, and there are a whole set of parameters that lay out for those people as to what they feel that their financial life is in or out of order. That is very complex.
And I would guess that one of the biggest benefits for consumers who end up working with you, let's say they enter into a debt management plan and they're paying back their debt, is they're making one monthly payment to you, and then you're dispersing to their creditors, and that alone probably reduces the complexity and makes them feel more in control again.
When we survey people who choose that option, and that's about maybe 1/5 of the clients who come to us, that's the reason they give, that it is the ease of operation and knowing that they can build their life around what's left after all of their creditors are identified, that the creditors on the plan. So yes, the ease of operation through the debt management plan is certainly a factor in why consumers choose that way. to help them manage their personal finances.
Tom, I'd like to shift back to the discussion about spending again. Chase has launched something called the Mindful Spending Center. Can you tell us a little bit about it and what you're sharing there with consumers and with those who educate consumers?
Sure. Mindful spending to us is really about helping consumers grow good, productive financial management habits. And the research indicated, and a couple of folks have spoken about it already, that as we come out of a difficult economic time, many people put in very short-term tactics to try to manage their spending. They were short-term austerity programs, belt tightening, whatever you might want to call it, which were very effective in the long term, in the short term, to helping people constrain their spending and really keep it under control. But now, as times look better, the job outlook seems more positive, and people are more comfortable spending, compounded by the fact that some consumers are experiencing what's called frugality fatigue, which is they've grown weary of the austerity program that they're under. The question now is, can they really manage well their spending and borrowing as they look into the future? Can they keep those tactics that they had and turn them into good habits that are there all of the time? So mindful spending to us is really about helping people think about those habits that they need on an ongoing basis to have a plan for and manage their spending and borrowing so that they're doing it mindfully, meaning that they have a real approach to doing that, that they have an idea as to how, when they borrow money, that they're going to pay it off, and then what they're spending, that they're doing within some plan like a budget. And mindful spending and our resource center for mindful spending is intended to help share our ideas and our research on that topic.
And Tom, will you let us know where's the URL where we can find that?
Sure. If folks go to chase.com/mindful spending, they will find it there. And it's a combination of the research that we've performed as well as the research that we partnered on others with that talk about spending and that all talks about spending and borrowing.
Yeah, you've got a great piece there on born to spend. Are we born to spend, or is it something a habit we develop? So that's also a great resource at that site. Let's go back to the financial complexity issue. You know, some of the folks who are joining us today are consumers who are saying, my financial life is not where I want it to be. I want to make it better. And some, like me and Linda and Rick, we're educators, and we want to help people make their financial life better. So, Ron, can you go back to the discussion about financial complexity and financial health? It sounds like it's sort of a chicken or egg kind of situation. You know, people feel out of control because their life is too complex, but it's too complex so they don't feel good. Where do you start when you look at this research? Where do you think we as educators can start?
Yeah, thanks for asking, because I do think that there are some things that not just educators can do, but financial institutions as well. And you're right about the chicken and egg, although I would kind of put the literacy and the complexity in there because that's what's impacting the health. I think from how do you move ahead, it kind of comes back to, in my mind, kind of a knowing and doing type of a construct. Education is certainly very important, and providing educational materials and things like that certainly helps consumers. But outside of the context of making the everyday decisions and their probably likelihood to not want to sit down at 10 o'clock at night where they'd probably rather be watching TV or doing something else than reading educational material, it's important for that educational material or educational construct to find its way into the point of decision or the point of influence. I think it was Linda who used it as mentioned it as the teachable moment when we had a prior discussion on this. And so providing tools to help consumers track their spending, manage their spending, and now with the advent of the mobile device, nearly 60% of consumers owning a smartphone, and doing a lot of research and product research and looking up products and things like that, being able to provide that sort of point of decision impact and educational material through the mobile device, not just on the online banking sites, I think is very important in finding ways to insert and interject that educational material or advice and guidance when consumers are actually at the point of making a spending decision.
So, Rick, you've been involved in financial education for many years. And what do you see in terms of the best practices and things that seem to really be working and resonating with consumers, at least the consumers that you work with?
You know, I think it comes to motivation, and if there are two types. If they're in crisis, if they come for a very particular problem, then it's more of a one-on-one trying to resolve the immediate crisis issue, rather than, say, group education where people are reluctant to discuss their own financial situation around others. So I think that the individual crisis counseling or coaching, if it leads to that, to help people change their behavior, is very important, and that lends itself to people who are more adept at they're in a deep crisis. They need to find a way out. For people, and by the way, recidivism for people who go through that process is very, very low. People who have a lot of debt and work their way out don't tend to get back there or go back there again. Group education in the communities, as you know, works very well. We're able to reach a lot of people. That applies and appeals to a certain element of the population, generally people who are older than, say, the younger millennials who tend to utilize the internet, and certainly the instruments that Ron alluded to, the mobile phones, the other devices that are available to help remind them about elements. On a national level, the National Foundation for Credit Counseling today has Sharpen Your Financial Focus, which Chase and other lenders support, which through their 600 offices nationwide allow consumers to come in and start the process, either if it's a crisis, immediate, or for long-term planning. And as a part of that, there's a self-assessment, an online tool for people who want to find out where they are, that allows them to take what we call a My Money checkup to answer questions, and it'll kind of assess where you are in the process. Locally, too, let me say that there are initiatives in most communities that will address consumer education and counseling. We have a great program here in San Francisco called Smart Money Network through the Office of Economic Empowerment through the Treasurer's Office that puts out all the information to financial providers in the community so that they can direct the message to the people that they serve regardless of their mission as a nonprofit. So, you know, I think it's a combination of group education. I think it's a combination of exploring the counseling to coaching for people that are in crisis, looking to develop long-term strategies to meet their goals, and then the use of the internet today. It's a combination of those plans.
And the fact that we need to reach consumers where they are. There are a lot of
yes, ma'am.
Linda, are you hearing echo on your
Little echo.
Okay, well, Linda, let's share your experience. Did I lose you?
Are we having it? Yeah, we're still having it. Not quite sure. One minute, we're gonna technical people for a second. This is a brave new.
Yeah. Why don't we try this? Maybe the rest of us can mute our mics, and then we'll see if Linda's not echoing then.
Well, one thing that we've been told, which seems to be gone now, which is nice, but if you have a window open trying to watch the Hangout at the same time as you're on the Hangout, that may be contributing to the issue they've told us. Jerry?
So Linda, before we ran into a little difficulty there, I was asking you about your experience with financial literacy best practices. You see a lot of different programs all over the country from different types of providers. What are some highlights that you think are working?
Well, I have to say that financial literacy can be pretty expensive to provide for folks. So one of the ways we do it at Consumer Action is we rely on a network of community-based organizations that we have, and it's a very informal network, but basically these educational groups who have clients in the community are interested in financial literacy. Now, they may have nothing else in common. They would be churches or libraries or homeless programs, a whole bunch of different types of organizations. But they all have an interest in getting people back on their feet financially and helping people save to build wealth, etc. So what they do is they order our publications, and our publications are free. We have training guides, and we have roundtables in the community to teach the community people how to use these materials. And it's kind of like a trickle-down mechanism that actually gives us a lot of bang for our buck, and a lot of our corporate partners, including Chase and others, help us do this and bring the community education to the materials to the community. And they seem very into it, the community. In fact, we get evaluations back, and they're like, we like these materials because we can go out and do a small or a large training and really help the people in our community and help them in languages and help them, whatever point they're at in time. And a lot of these network agencies also include affiliates of Rick's agency, of the Consumer Credit Counseling agencies, and they really are into the idea that they can hold these little seminars for people or help people one-on-one by giving them a brochure and maybe going over it with them. So that's one way. I also think that people really kind of underestimate what's there with the financial services that they already have. If we can convince people, and we're working all the time to convince people to have a real, a bank account or a credit union account, something basic that can help them manage their finances. And of course, from my perspective, I always say you only need 1 or 2 credit cards. All of these companies actually are offering great services to people if they knew they were there. Now, for instance, to reduce the complexity of not paying your bills on time, you can get alerts, and you can get account aggregation. And account aggregation is just a fancy word for bringing all your accounts into one big list where you can look at them, and you can get this either, in many cases, through your own bank or through something like mint.com. And it lays it out for you. It lets you look at pie charts and all this cool stuff that really lets you see, where am I with this? And by setting the alerts so that you don't miss payments, you'll cut down on fees and that kind of, the things that add to your stress of not paying on time. So I think people need to examine, if they're not banked, they really need to see that there are good reasons to be banked. And we have a lot of publications that can help them get banked, even if they've had trouble in the past with bank accounts. So I think people really need to look at the financial services that they already have and see what tools are offered through them to help them get back on their feet or do a better job at managing their finances.
Tom, you literally at Chase have millions of customers that you deal with across the country. So what's your perspective on this topic?
Well, I believe that. Are we echoing?
Hold on one minute.
I'll try it again. Is there an echo? So at Chase, while we have those millions of customers, I think some of the points that other folks brought up that you really need to understand when it comes to literacy is that it needs to be timely and relevant and understandable for the customer. So that's why people who enter in credit counseling are very amenable to the messages that can be learned there, because it's very timely, it's very relevant to them. What's important also is that it's understandable. And what some of the research that Ron referenced earlier, but what we've also seen is, and I think it's very directly in line with what Linda talked about, is customers starting with the products that they already have and trying to understand them, but reaching out directly to a banker to get that understanding really helps to increase their literacy. So it is there a function of it's timely and it's relevant, but that banker, that individual, can help make it understandable. And the research that Ron and his firm did indicated that of the people who believed that their financial situation improved, more than 40% of them had spoken to an individual at a bank to help them understand their financial situation. So I think it's really a combination of all of the efforts. It's the information that's available, it's the way it's delivered, but it's that timeliness and that relevancy that really helps connect with the customer and increase their literacy.
And I can't agree more. I think the personalization is the big factor. You know, and maybe it's me. Consumers we can write a million ways about credit scores and what to do to keep your credit score high, but when they actually come to credit.com and get their credit score and see what's affecting it, that's when they're really ready to take action. So I think you're exactly right, Tom, that there is that time when someone realizes I'm ready to make a difference in my financial life, and this is the next step that I need to take. If you're just joining us, we have a Google Hangout going on here talking about research in the Aite group sponsored by Chase Blueprint and Consumer Action, and we are talking about financial literacy, financial complexity, and financial health. So I want to shift gears once more. Ron, we're probably going to go another 10 minutes or so, and we do have a couple of questions that we want to take at the end. Ron, I want to talk about different age groups because we all serve a wide range of consumers in different age groups. Did your research get into how consumers of different ages feel about their financial health and the financial complexity in their lives?
Yeah, absolutely, and would hope it would not be surprising to many people on the Hangout here, but younger consumers, the Gen Yers in particular, were disproportionately impacted by the recession, as well as disproportionately impacted by the recovery as well, being that they were actually a higher percentage. Both said that they had improved their financial life since the depths of the recession, but also a disproportionate percentage said that they were negatively impacted. And that's probably not totally surprising given where they are from a demographic and life stage perspective. You know, over the past 4 to 5 years, many Gen Yers are kind of moving out of the college age into the point where they're on their own, or perhaps even a little older and starting families, where the financial pressures certainly get a lot higher. So, you know, this is no more worrying about which bar to go, you know, get some drinks at on a Friday night. Now it's a matter of how am I going to pay my mortgage, or even get a mortgage and save for kids. The positive side to this, though, is that not just in the research that we did, but I'll tell you the research I've been doing over the past couple of years continues to show that younger consumers at this particular age, in their 20s, mid to late 20s, are a whole lot more engaged in the management of their financial lives than older consumers were at that age. And as a baby boomer myself, I could tell you I was not aware of what a credit score was at 25, was not thinking about saving for retirement. And today's Gen Yers, many of them know about what a credit score is, are actually more concerned about saving for retirement, and as we've kind of alluded to, are a whole lot more likely to be using the electronic tools, the online and mobile tool banking and payment tools that are available both through their banks and credit unions as well as other sources. And so they're likely to have more access to the sources of education. So I think that's one of the big pluses here with the younger consumers, although they've been disproportionately impacted both positively and negatively by the recession.
Well, along those lines, Rick, what do you see in terms of the consumers who seek help through your agency?
Yes, I think it comes down to goal setting. And if you want to change your financial behavior, if you want to have a plan, you need to have a goal. And obviously the goals of the baby boomers, people moving towards retirement, are more along the lines of eliminating debt, making good choices around how they're going to finance their retirement, perhaps looking at the amortization left on their home loan to see what they can do to shorten that. And so therefore their goals are entirely different than, and I agree with Ron 100%, the millennials who are coming in, their goals are not necessarily the same. They're looking for ways, for instance, or they're questioning whether or not home ownership is good for them. Whereas the baby boomers, we felt like home ownership was a good thing. Everyone should have a home. And I think part of that problem comes from the last 6 years and the bad press that home ownership has garnered based on the foreclosure epidemics. And so I think they're willing to look at that in a different light, and also how they manage their own finances They are willing in suburban areas and metropolitan areas, for instance, to use more public transportation. That has an impact on their own budget, their own how they spend their money, rather than trying to own a car. They are feeling like everybody has to have a car. And so I think it boils down to what their goals are and what their motivations are. And if you really want to change your financial behavior, you need to have a reason to do so. And certainly the younger crowd, their reasons for managing their money, taking advantages of all the tools that are there through their bank, through their credit union, online, either coming in to see us for one-on-one sessions, is because they're motivated in a different way than the older generation, the baby boomers might be, who are heading towards retirement.
Linda, do you have any suggestions for resources for younger consumers who are struggling?
Well, when I think about younger consumers and when I talk to them as well, my nieces and nephews and other people, I think that it really is good to stress that finding better paying work, finding a job that you like and that pays well in life is what will help you really achieve financial stability in the long run. So I say that these kids at this age should really start thinking more about what they can do to increase their earnings, get a better job. And there's many, many resources out there for that. There's networking events, there's job postings online, there's Q&As, and really the other thing is be extremely careful at what you put on your, in your application letters. And one typo can cost you a job. I mean, that could follow you around for the rest of your life. So be careful about that. But the other place that I say young people should really have a lot of problems today is with the student loans. They're coming out of school owing as much as other people owed on a house mortgage. So I think that this is really making it difficult for them to step into their adult lives and do those things that people want to do, start families and buy homes, etc. The CFPB, the Consumer Financial Protection Bureau, has some great resources on how to get your student loans in order, and if you have any rights perhaps for forgiveness or working with certain organizations that would maybe give you some advantages in paying back your loans. And I highly recommend that anyone with student loans go there and look at that. And on the other hand, people who haven't yet accumulated student loans should really consider things like community college for the first 2 years, get really good grades and transfer out. Because there are so many problems with the for-profit schools now, and people are coming out of school with degrees that aren't really serving them very well, and also with huge debt backpacks on their back.
Before we wrap up, Tom, share your thoughts on what you see from your perspective as a card issuer in terms of the different age groups and how that relates to how consumers are managing their financial complexity and their financial health.
I think what we see and what our research has shown is that the issues and the challenges that people have managing their financial situation spans across generations. And sometimes they change as their life and their life stage changes. But really what it comes down to is understanding what your goals and objectives are, having a plan. Just the mere fact of having a plan helps people achieve their goals, and staying mindful about how you spend and how you borrow. People describe that there are surprises for them financially at all ages, but in reality, life happens to everyone. And so whether you just own a car or you own a car and a house, there's always some new expense that comes out of those things that you don't anticipate. So it's very helpful to plan for the unplanned, because there's always a car repair that's coming sometime in the future, or a house repair that's merely a few months away. And if people recognize that they don't know exactly what those events will be, but there will always be those events, and they plan, and planning includes taking care of your credit, having a good credit rating so you can get credit if you need to borrow. That's all part of that planning. But having those ideas and those plans in place really help you manage through those challenging times, really regardless of where you are from a life stage perspective.
And Tom, real quick, share some information you've learned through the Chase Blueprint program, because you have some pretty amazing statistics in terms of what a plan does to consumers in terms of paying off their balances.
Yes, I mentioned it earlier, but what Blueprint allows our customers to do is to set a plan to either pay back their balance or pay down their balance or pay off a large purchase. And what it amounts to is they're able to take that amount that they owe and translate it into specific, the same monthly payments. And what we have seen so far is that over 3 million of those plans have been created. So customers created their own plans, but in more than 90% of those cases, they've actually met their plans. So it's an incredibly high success rate, and we attribute that very much to them setting their own plan. It's a plan that they have committed to, and now they're going after it, and they're meeting the terms of that plan. They're paying down their balance according to the plan that they set up, or they're paying off that large purchase according to the monthly payment that they themselves agreed to, and it seems to be a real positive driver of their behavior, and it's all about that goal setting and creating your own plan.
Well, as we go to wrap up here, we've shared a lot of great information. I want to make sure everyone gives out their website, so anyone who wants to learn more can do that. And I want to end with a final thought. We had a question from Charles in Virginia. He submitted a question earlier, and he asked, what could we do on a national scale to improve financial literacy? So let's each go through, share our best idea for that, and then go ahead and give your website. Let's start with Rick, since you're up on the screen.
Well, let me emphasize again that I think the current initiative, Sharpen Your Financial Focus, through the National Foundation for Credit Counseling, which is rolled out to nationwide through 600 different locations, consumer credit counseling service agencies, is a great place for people to start the process. All they need to do is make a telephone call, make an appointment, come in, have someone help them put a plan together, take the self-assessment, My Money checkup to find out where they are, that they can do themselves, and then establish those goals and work with the local representatives to make those goals a reality. So I think that's a great place to start because it is a national initiative.
And let's have your website as well, Rick.
It's cccsf.org.
Okay,
Consumer Credit Counseling Service of San Francisco.
Okay, thank you. Linda.
Thanks, Jerry. Well, one of the things that we've done in connection with Chase is we've put out a tip sheet of advice for people who need to rebound, and that is available on our website, and I'll put it up on the homepage just so people can find it easily. There's a lot of good advice in there as far as how you can get back on your feet if you're not one of those people whose finances have improved over time. The other thing is I really am a big fan of Chase Blueprint. So anybody with a Chase card should know that this service is there. It's not on every card, but not only does it do the things that Tom told us about, it allows you to identify certain kinds of things that you perhaps would want to pay in full for every month, and thereby you will avoid interest on those things. Now that's completely revolutionary in the credit card world, because when you have a balance you're going to pay interest, but not with the Blueprint program, because you're able to pay your groceries off at the end of the month, or your pharmacy bill, whatever you identify, and you will have no interest on those items, but you will be able to tackle the debt and pay it down with the program that you developed yourself. So kudos to Chase for that program. And our website is www.consumer-action.org. And we welcome anyone that would like to come and see us. And we also have a hotline they can call us on, and that's available on the website as well.
Yeah, and the hotline is very important because you reach a lot of consumers and help them find a solution to whatever consumer problem they're dealing with. So again, that's consumer-action.org. Ron Shevlin, thank you so much for sharing information about your research. Tell us a little bit about the Aite group and where consumers can find more about this research study.
Yeah, thanks, Jerry. Aite group is actually, Aite is a Japanese word that means partner or counterpart. It is spelled AITE, and we are at www.aitegroup.com, and we've got a lot of research published on the site.
Okay, Tom.
Yeah, thanks, Jerry. I think that the work that Consumer Action is doing, consumer credit counseling, it's fantastic work, and it helps just a large number of consumers today really get their arms around understanding their situation and developing their own personal plan for managing it. One of the research projects that we participated in this year, and it's in a paper that's called Born to Spend, looked at how do we continue to develop those literacy efforts so that they really connect with people over time. How do you leverage technology to do that? How do you use things like gaming to help people really understand their situation, because those are clearly ways that people are engaged today. And so I think as we look to the future, it will be to continue to try to develop those ways that we can really connect, all of us can really connect with consumers to help them improve their literacy and help them improve their financial situation. So if folks are interested, I suggest they go to chase.com/mindful spending. Again, they can see that research there, but I think it's also our way to provide some of what we've learned and put it out there for folks to see the same things that we're learning, and hopefully it will help them in terms of developing new and better ways to manage their money.
And I'll add from my perspective, of course, we'd love to see consumers take advantage of their right under federal law and get their free credit reports every year, annualcreditreport.com. A lot of consumers do not take advantage of that, and it's something that's really important. We give consumers a free credit score at credit.com. We're happy to help them that way as well so they understand what their credit report means. And then I think one of the ways that we can really help raise financial literacy is by training the trainers, and that includes training teachers. We hear a lot about why we don't teach financial education in school, but most teachers don't feel that they are equipped to do that. And to do that, they need the training and resources, and I know there's some great organizations out there. Jumpstart Coalition for Personal Financial Literacy is one. Junior Achievement has been teaching financial topics in schools for years. I'm a volunteer, and I encourage anyone who is watching to consider getting involved with Junior Achievement as well. But I think if we can train the next generation, the one that's struggling really, really hard right now, that's just going to be crucial to the financial health of all of us, including, you know, the next generation coming along. Well, I want to thank you all again for joining us today. It's been a great discussion. Thank you, Chase Blueprint, for sponsoring this. Consumer Action. Rick, thank you for joining us from Consumer Credit Counseling Service of San Francisco. And Ron, Aite Group, thank you so much for the research and the insights you've shared. I'm Jerry Detweiler, and we'll have a recording of this available after the Hangout.
Thank you.
Thank you, Jerry.
Bye.